KLA Corporation just did something that made thousands of shareholders check their brokerage app twice. Overnight, every single share of KLA turned into 10 shares. No, this isn't a glitch, and no, nobody suddenly got 10 times richer. But here's the strange part. Even after that massive stock split, the stock is still up nearly 98% over the past year. So what's actually going on with this company? Let's dig in because the numbers tell a story that's a lot more complicated than most people realize. Let's start with the split itself, because it's the freshest piece of news here. On June 12, 2026, KLA executed a 10-for-1 forward stock split. That means if you owned 1 share before, you now own 10. The price per share also divided by 10, so on paper, nothing about your actual investment value changed that day. Companies usually do this to make shares more affordable and easier to trade for everyday investors. But splits alone don't explain why a stock would be up 97% over 52 weeks. That kind of jump usually means something deeper is happening with the actual business. So let's look under the hood. KLA currently has 1.31 billion shares outstanding, and interestingly, that number has actually gone down by 1.34% over the past year. That's a clue. When share count shrinks instead of grows, it often means a company is buying back its own stock, which can be a sign of confidence from management. And sure enough, there's a metric here called buyback yield sitting at 1.34%, which lines up perfectly with that share reduction. Now here's where things get interesting. Only 0.09% of KLA is owned by insiders, meaning the executives and board members themselves hold a razor-thin sliver of the company. Meanwhile, institutions, big funds, pension managers, and professional money managers own a massive 88.29% of the entire companies. So this is a stock that Wall Street's biggest players are deeply invested in, even though the people running the company personally hold very little of it. Is that a red flag or just a normal reflection of how many shares are out there? That's something worth sitting with as we go further. Let's talk about profitability because this is where KLA starts to separate itself from an average company. In the last 12 months, KLA generated $13.58 billion in revenue and turned that into $4.83 billion in net profit. That's a profit margin of 35.57%, meaning out of every dollar that comes in, about 36 cents becomes pure profit. For context, that's an extremely high margin. Most companies would be thrilled to keep 10 or 15 cents of every dollar. KLA is keeping over a third. But at first glance, that sounds impressive, and it is. But here's the number that really stands out. KLA's return on equity, or ROE, is sitting at 87.50%. In simple terms, ROE tells you how efficiently a company turns shareholder money into profit. A number in the 15 to 20% range is usually considered strong. KLA is sitting at nearly 90%. And it doesn't stop there. Return on invested capital, or ROIC, which measures how well a company uses all the money it has, both from shareholders and debt, is at 67.97%. These are not normal numbers. These are the kind of efficiency numbers that make analysts pay very close attention. So naturally, you'd expect the stock to be expensive, right? And that's exactly what we find. The trailing P/E ratio, which compares the stock price to its earnings, is sitting at 49.95. In plain English, investors are currently paying about $50 for every $1 of KLA's past year profit. That is a high price tag. However, one number changes the picture slightly. The forward P/E, which is based on expected future earnings, drops to 33.55. That's still not cheap, but it suggests the market expects earnings to grow into that valuation over time. Now let's flip to the balance sheet, because this is where a surprising contradiction shows up. KLA holds $4.90 billion in cash. Sounds like a fortress, right? But the company also carries $5.89 billion in total debt. When you subtract debt from cash, KLA actually sits in a negative net cash position of about $985 million. In other words, despite having nearly $5 billion sitting in the bank, the company technically owes more than it holds in cash. This is where investors often get confused, because a big cash pile can create a false sense of security if you don't look at the debt sitting right next to it. But before you read too much into that, here's the counterbalance. KLA's current ratio, which measures whether a company can cover its short-term bills with short-term assets, is 2.88. That's considered very healthy. Generally, anything above 1.5 or 2 is seen as strong. On top of that, the interest coverage ratio is 19.90, meaning KLA earns almost 20 times more than what it needs just to pay the interest on its debt. And if you want the ultimate financial safety check, the Altman Z-score, a formula designed to measure bankruptcy risk, comes in at 12.01. Anything above 3 is typically considered a safe zone. KLA is sitting at 4 times that safety threshold. Let's shift to cash flow because profit on paper and actual cash in the bank are two very different things. KLA generated $4.40 billion in operating cash flow, and after subtracting $387.07 million in capital expenditures, that is, money spent on equipment and infrastructure, it was left with $4.01 billion in free cash flow. That free cash flow is essentially the leftover money a company can use for dividends, buybacks, or reinvestment without borrowing a dime. And speaking of dividends, KLA pays shareholders 92 cents per share annually, which comes out to a dividend yield of 0.50%. That might sound small, but here's the twist. The dividend has grown 18.52% year over year, and the company has increased its dividend for 10 consecutive years. The payout ratio, meaning the percentage of profit paid out as dividends, is only 21.86%. That's relatively low, which means there's plenty of room for that dividend to keep growing if the trend continues. Now, here's a detail that might surprise you given how much the stock has already run up. The Relative Strength Index, or RSI, is sitting at 38.24. RSI measures whether a stock has been overbought or oversold recently, with readings above 70 typically signaling overheated buying and readings below 30 signaling the opposite. A stock that's up 97% over the year sitting at an RSI of 38 is not something you'd expect. It suggests that in the short term, buying momentum has actually cooled off, even while the long-term trend remains dramatically positive. There's also a quieter signal worth mentioning: short interest. Currently, 27.94 million shares are sold short, representing 2.14% of all outstanding shares. That's actually down from 34.38 million shares the previous month. In simple terms, short sellers are traders betting the price will fall, and right now fewer people are making that bet than before. So where does Wall Street land on all of this? Out of 29 analysts covering KLA, the consensus rating is buy, with an average price target of $230.85, which sits 26.27% above the current price. Analysts are also forecasting revenue growth of 19.99% and earnings growth of 26.69% over the next 3 years. So, let's bring this together. On one side, you have a company with extraordinary profitability, a return on equity near 90%, a fortress-like current ratio, and a decade of consistent dividend growth. On the other side, you have a stock trading at a premium valuation, a technical net debt position despite billions in cash, and insider ownership sitting at a razor-thin 0.09%. Both of these realities exist at the same time, inside the exact same company. So here's the real question worth thinking about. Can a business with this level of efficiency and cash generation continue justifying a premium price tag? Or does the gap between valuation and ownership structure eventually have to close one way or another? That's something only time and KLA's next few earnings reports will answer.